Thanks, everyone. So I also hope to get through in the allotted 10 minutes. I'll draw your attention to our disclaimer, which you can read at your leisure. Just an overview of the business. We're an owner of the Blanket Gold Mine in Zimbabwe. It's a mine that we acquired of Kinross in 2006. It was in pretty good shape when we bought it, and we've had it for 12 years, and it's been a fantastic investment for the business. We've owned it through all of the difficult times in Zimbabwe, and it's great to be operating in a country with an operating environment that's improving quite substantially. So in terms of scale of the asset, it's about, last year we did 56,000 ounces. That's an all-in cost of just below $850 an ounce. We are currently investing fairly heavily in the mine to grow production up to 80,000 ounces by 2021. That'll also extend the life and chase resources at depth, which we have a fairly healthy resource growth, which I'll show you in a moment. We are pretty well cashed up, fairly strong balance sheet, $13.5 million in the bank, a very small amount of debt, so net cash is just below $12 million. And we pay a dividend of currently yielding about 3%, and that's paid every quarter. So for a junior company capped at $90 million, we think that's a healthy track record that we're quite proud of. So our capital structure, you can view at your leisure. The chart in the top left-hand corner is our performance over time. We benchmark ourselves to GDXJ. A lot of the outperformance really comes from the dividends. So especially when the yield used to be quite a bit higher, and that's not even counting reinvestment of those dividends. These are our financial results. We are building a pretty solid track record. The number I draw your attention to there is operating cash flow, middle of the slide. Last year, this business generated $24.5 million after tax on a consolidated basis. For a business with a market cap of $90 million, we're quite proud of that number. Most of that was reinvested. I mentioned we are investing to grow to 80,000 ounces, so we invested $21 million last year, and then with a dividend of $3 million, which kept the cash balance flat. That investment program will be complete. We'll commission this project in 2020, and then we'll be in the happy confluence of events where operating cash flow will rise quite substantially, capital will drop because we'll complete the project and commission it, and long-term sustaining capex for this mine is about $5 million, and we'll have a very nice stream of free cash flow which we can either dividend out to shareholders or look to capitalize on Zimbabwe. Speaking of Zimbabwe, I mentioned, for those of you who don't follow the politics, there was a change of leadership last November, after 37 years of the same rule. We don't think it's overselling this to say that Zimbabwe is really one of the last gold frontiers in Africa. Most people don't know this, but back in the 1980s, this was the third biggest gold producing region in the continent, behind South Africa and Ghana. And it was bigger than Mali, bigger than Burkina, bigger than all of these other places. And since then, it's had very, very little investment. And we really believe that obviously the gold is still in the ground, and there's quite a substantial opportunity for us to go after that. We're down in the south of the country, the Gwanda Greenstone Belt. But the country's produced 45 million ounces of gold to date, and that has tailed off quite a lot, obviously, with lack of investment. But we do feel, we know where a lot of these attractive assets are, and we have a very strong cash-generating asset in the country, which we will be bringing to account and have quite healthy free cash flows from 2020 onwards. I'd encourage you, if you want to take a view on the politics, this is an article that the President wrote in the New York Times, which was published about 6 weeks back. You obviously have to take him at his word, but it maybe can speak louder than anything we can say in terms of the intentions of the new leadership and what they're planning to bring about in country. In terms of policy changes, two of the concrete things that have happened in Zimbabwe that we regard as fairly substantial. The first is they've completely scrapped local indigenization laws. So Zimbabwe had fairly onerous local ownership laws. 51% of assets had to be owned by local Zimbabweans. We were the first mine to comply with that. We put the structure in place in about 2012. And that essentially was a fairly typical South African BEE style structure where we loaned our local partners money to invest in the asset, and we're in the process of collecting the majority of the dividends from that transaction until such time as those loans are repaid. With the change in law, which was promulgated in April, we're now in a position to increase our ownership of the mine. We've stated publicly that we're in discussions with some of our local partners. We're a willing buyer. It looks like they're a willing seller, and this is an issue we're hoping to address fairly shortly, but we're in a position to increase our ownership of this asset hopefully this year. The second thing that we've seen Zimbabwe do in terms of fiscal terms is increase. There's an export credit incentive which now exists. We effectively have a negative 5% royalty in the country. Probably makes it the best fiscal terms, I would say, in Africa and possibly even the world. 25% tax rate, 100% capital write-off, and a royalty of -5%. This is our resources. We've got about 1.6 million ounces, grown pretty healthily since we've been investing, and this is the food for the capital project. I mentioned we're investing fairly heavily in growing production to 80,000 ounces. This is a long section of the asset, so that's about 3 kilometers left to right. That's the 750-meter constraint, which is where the grey stuff is the old workings that we've mined out. That's our current production infrastructure, which is what we inherited from Kinross. It was in pretty good shape when we bought it, and it served us well, but it's been 12 years now, and we need to start investing to go deeper. That's where our men come up and down. So you can see it's on the right-hand side of the structure. This isn't how you would build it if you were to build a mine from scratch. We are investing. We've put in $60 million so far, and we are probably got about another $50 million to go over the next 3 years to 2020. There's a brand new shaft going in right in the middle of the mine. We can mine 4 new production levels, which will open up resources at depth. It'll enable exploration at depth. We haven't found the bottom of any of these ore bodies. The mine is 112 years old, and it's never ever had a 112-year mine life. So we certainly don't feel resource constrained as a business. As we get deeper, we'll be in a position to go after this. The resources that we know are there, that you can see shaded in color below that 750-meter line. But also we feel pretty confident we're going to keep finding stuff. That's just some photographs. Those guys are 6 foot tall. This is not a small operation. This is a decent underground operation that would stand back to nobody anywhere in the world. I've seen mines in Canada and all over Africa, South Africa. This is certainly an operation we're very proud of. That shaft is currently at a depth of 1 kilometer below surface. As I say, it'll be in production by 2020, and it'll be fully ramped up by 2021, and then we'll be 80,000 ounces. Well, there you go. That's what it means for our production profile, right? So this is historical production. You can see a decent growth trend since the hyperinflation when we shut the mine down in 2008, but we've grown quite healthily since then. And this is where the maths gets easy, right? We'll be looking at 80,000 ounces at an all-in sustaining cost of $750 an ounce. So at current gold prices, that's $550 an ounce operating margin. You can pick your gold price, but essentially that gives us about $45 to $50 million of EBITDA for a business with a market capitalization of $90 million. Again, there are taxes and minority interests as the indigenization structure I mentioned, so we don't get all of that, but we can see our way to. In fact, this is probably the most important slide, and I'm coming up for time here, but this is straight out of our cash flow statement. This is operating cash flow after tax on the light gray bars, and then CapEx in the dark green bars. The historical numbers there are actuals out of our cash flow statement, and then forward you can see the CapEx tails off, and as we commission the project and ramp up, the operating cash flows ramp up. The blue bars are the free cash flow. This is, like I say, 80,000 ounces, $750 all-in sustaining. That's $45 to $50 million of EBITDA, which after taxes and minority interest gives you free cash flow of anywhere between $20 and $30 million a year that we'll get for ourselves. So our dividend currently is $3 million, so we could afford to grow that dividend very, very substantially, or we could look at some of the opportunities that we've seen in Zimbabwe, which we feel are quite attractive. We have announced also recently that we're spending $4 million on satellite exploration. When we bought the mine from Kinross, there was a tailings plant that was operating, so our cyanide capacity is almost double the current capacity that we need. So we have about 18 satellite properties, and we're busy exploring those. And if we find any sufficient resources there for satellite feed, we might be able to get above the 80,000 ounces. But that's certainly not guidance, and this is all exploration dependent. But we've taken the step, particularly given the improving fiscal situation in Zim, to begin exploring for that. I mentioned the dividend. The yield's about 3%, so it's still reasonably healthy yield. It used to be much higher, but the share price has rallied since then. Like I said, the dividend is 8 times covered by current operating cash flow. When the capex tails off, we'll be in a position to grow that dividend substantially. We could double or triple this dividend without even breaking sweat, and still have a war chest building up to take advantage of opportunities in Zimbabwe after 2021. So that's pretty much all I've got. You can read the summary case at your leisure, but a decent growth opportunity. A pretty attractive dividend yield still, a good margin operation. We back ourselves to survive any gold price that we could see in the future, and we think our track record starts to speak for itself. So thanks for your time.